Today, let's talk about something that lots of you have questions about, angel investing. So we're going to dive into what angel investors are, what to watch out for, and if you're ready, how to find them and how to raise money. My very first investment was an angel investor who went on to become my business partner. He was an incredibly helpful support for many years, and I was very lucky to have him. I found him completely by accident, really, through a university competition. After working with me for about a year, he eventually offered me investment and stayed on as my business partner and shareholder for almost 10 years. But if you're not sure what an angel investor really even is, well, they're usually a high net worth individual who provides financial support to early stage startups in exchange, usually for equity, but sometimes for debt. These investors typically invest their personal wealth and typically play quite a crucial role in the initial funding of new ventures. Angel investors usually bring more than just funding to your startup too, so they often have years and years of experience of their own. They often have industry contacts and lots of valuable advice to offer. In fact, quite a lot of successful entrepreneurs become angel investors themselves. I myself am one. It's really nice to be able to give back to that new generation of entrepreneurs. While angels can provide significant benefits to your startup, it's really essential to be aware of potential pitfalls. You can really get this wrong and it can dramatically affect your business forever. So number one is giving up too much equity. Be really cautious about how much equity you actually give away. It's crucial to strike a balance between attracting investors, but also maintaining control over your company. 2, misaligned goals. This is especially important for mission-led businesses, so you need to ensure that your angel investor shares your vision and goals for the company. Misaligned objectives can lead to conflicts down the road. You, as a mission-led entrepreneur, are here for more than just making money, so they need to understand that. Number 3 is inexperience, actually. Some angel investors may lack experience in your particular industry, or they just have limited knowledge about the startup ecosystem. Some people just have money and want to invest it, but they don't really have the other benefits. So be sure to do your due diligence and assess their track record before you accept any investment. If you just want dumb money, fine, that's great. But if you want advice and help, ensure their experience is helpful. Number 4 is loss of focus. So accepting investments from multiple investors might actually lead to conflicting advice or differing priorities for your business. This comes back to making sure everyone's in line with the goals and the mission of the business. Be mindful of the potential distractions and stay focused on your company's vision and strategy, and just make sure everybody knows what that is. Number 5 is overvaluation. A high valuation might seem attractive initially, but it actually causes you problems because it places undue pressure on your startup to deliver unrealistic results. So make sure you aim for a fair valuation that reflects your company's potential, but don't overstate it because that will actually do you more harm in the long run. On the other hand, of course, if you undervalue your company, then you're giving away too much equity. So it's actually a hard balance to strike. What is the answer to valuations? I have been told multiple times it's a bit of black magic, so we do have a lesson on valuations coming up. So you definitely want an angel investor. What do you do now? Number 1, start building your network. You probably know angel investors and don't even know. So get networking, and yes, I know a lot of us hate it. Networking is key to connecting with potential angel investors. So attend industry events, join startup communities, leverage your personal professional connections. A lot of angel investors hide what they do on the side because, frankly, we get harassed a lot. Number 2, look for angel investor groups. There are heaps of angel investor groups out there where like-minded angels will form investment collectives. In Aotearoa, New Zealand, we have at least 20 groups, all with focuses on different things from female founders to tech groups to impact investment and even FMCG. So look for a group that fits your niche with what you want to do because they are much more likely to give you a warm welcome. And start on Google. Number 3 is develop a solid business plan. Not a 50-page business plan. We all know how I feel about those. But you need to have a plan with what you want to do with the money or why you're raising money. And I have had pitches from people who say, oh, we just want to have the money in the bank. That's a really bad strategy. Start with a plan on a page. You know how much I love my plan on a page. And go into much detail about things like the how and the what. And of course, you're going to need solid financial projections that preferably someone independent has prepared, unless you're a chartered accountant. A well-crafted business plan demonstrates that you've got thoroughly researched and planned for your venture. 4, pitching. Pitching at the beginning is pretty terrifying. I remember absolutely bombing my first ever pitch, and it was a hideous nightmare of embarrassment. All because I was so nervous, I forgot how to breathe, and I think I forgot entirely what I was going to say. But to attract angel investors, you need a clear and concise pitch that showcases the why behind your business idea, your team, if you have one, and your growth potential. But make it realistic and based on solid assumptions, not just we're going to go and set the world on fire. Make sure that you can articulate your vision, the market opportunity, and your revenue model effectively. We'll have a model on investment pitch prep. You'll also want to show that you have traction if you do. Angel investors want to say that your startup has a market. Demonstrate traction through metrics like user growth, revenue, partnerships, whatever you can to show that people want your product. 5, do your research. Before approaching angel investors, research their backgrounds, industries of interest, and their investment history, because this will help you tailor your pitch to them and their interests, because a lot of angel investors want to invest in what they like. This is a long road, and patience is key. Finding the right angel investor may take time, but be patient, be persistent, and don't be discouraged by no's. You will get way more no's than yeses, and that's good because they're not the right fit for you. You don't want to say yes to everyone. Every interaction is an opportunity to get better at pitching. For the love of God, don't rush it and just say yes to money that isn't a good fit. Which brings me to my next point. You need to have a runway. What's a runway? A runway is simply the term given for the amount of time you have at your current cash burn rate, or how much you're spending your money, before you run out of it. Ideally, you'll start a capital raising process with at least 6 months runway. Ideally. Once you have an angel investor on board, congratulations, it's all very exciting, but how do you ensure success? So you need to ensure that you have open lines of communication with them. You keep them updated on everything, challenges, opportunities, exciting things that have happened, major issues, minor issues. Their experience and insight can prove invaluable to navigating difficult situations. It might feel counterintuitive to tell them these things, but investors hate surprises. You do not want to go to them and out of the blue say, we're running out of money, can we have a couple of $100,000? They hate that. Keep them updated on your challenges and let them help if they can. You've got to understand what investors want. They want a return. Even impact investors want a return, because then they can go and invest in the next impact fund. It's usually within a certain time frame, whether it's roughly 5 to 7 years, but be transparent about your exit strategy and have a plan to meet those expectations. Yes, I found it super weird when I was first asked what my exit strategy was. I had just started this business, I had big aspirations, I wanted it to be $1 billion brand, and people were asking me when I wanted out. But they want to know that because they need to know when they'll get their money back. Most of them are not in this to be nice, and that is something to bear in mind. So always have an answer on what your exit strategy is. And don't forget, many angel investors offer valuable mentorship and guidance to entrepreneurs, and don't hesitate to seek their advice and learn from it. But not all advice is good advice. Bear that in mind. A good mentor will not mind if you don't take their advice. It is a sign of a bad mentor if they get cross with you for doing the thing that you thought was right, which is in opposition to their advice. Some advice is freaking terrible. Actually, a lot of the advice I received as a young entrepreneur was appalling. And the biggest thing that an angel can often bring is their network. So leverage their extensive network within the industry, because it can make really valuable introductions to potential partners, customers, future investors, retailers. Take advantage of it. You have no idea where those connections will take you. Some of the best things that have ever happened to a teak happen because of connections. That is Angel Investing 101. If you have any questions or you want me to go into anything further in future lessons, please let me know in the comments below.